special opportunities, $3.5 billion. What are those special opportunities? How do you plan to deploy this capital?
Sure. Hey, Eric. Hope you had a great weekend. Thanks for having me. It's interesting. Special opportunities, I think some people would call special situations, but we've called it special opportunities because we think that we've taken a much different approach than some of our peers have to investing throughout the distress cycle. Whereas a lot of folks, I think, are focused on the liquid markets, buying securities at a discount to par. We've been really trying to leverage Ares' private market capabilities in and around the private credit markets. So we, like many others, were very busy in March and through the first week in April. And then when the markets changed, a lot of that traditional distressed opportunity went away. Interestingly, at that point, we saw the fundraising for this specific pool of capital accelerate. We had originally set out to raise $2 billion for this particular fund and wound up closing it through the hard cap at $3.5 billion.
So why private versus public? Is that because Fed liquidity is crowding out what's happening in liquid markets?
I think it's a couple of things. We had been talking even pre-COVID about the secular changes in the liquid credit markets, a greater move towards size and scaled issuers, more malleable credit documents, lack of information edge and research advantage. So a lot of the things that folks like us used in prior cycles to generate alpha in the liquid markets, frankly, aren't available to us. So we decided years back to pivot into the private markets. And interestingly, this particular team sits within our private equity group. So we have a pretty strong view that if you're going to be in distress, you not only have to be in the private markets and understand those private securities, but you then need to be able to go into those companies and add value. So yeah, I think the Fed kind of took away a lot of that traditional opportunity pretty quickly from folks.
Mike, is there distress already in these private credit markets? Because people who look at what's happening in investment grade or even in high yield and see how quickly they've recovered from the March lows might think that the whole credit world is healthy.
Yeah, I think we have to all be very careful, and you and I have talked about this before, that we don't conflate the markets and the real economy. And so while the technicals in all of the liquid markets that the Fed has been supporting are fantastic, if you peel back and look at the fundamentals, the recovery is uneven. I think we have to make sure that we don't confuse a rebound for a sustainable recovery.
So where is the Fed liquidity not reaching? Where are things attractively priced?
Yeah, so we've been able to find distressed opportunities in first order COVID impacted industries like travel and leisure, outdoor advertising, media and entertainment, things like that. If you move to the second order, you have to look at it in two places. One, where is the liquidity not finding its way? There are certain pockets of the mortgage-backed securities market that have not been supported. Some small business loans, some middle market corporate loans, private equity-backed loans. So there are a number of pockets of the markets that have not benefited from the Fed liquidity, and that's a place where we can come in with our own liquidity and provide that support. And then, as we've all seen, even though the liquid markets are functioning, there are a whole host of private companies who never really prepared for a situation or a world where there was zero revenue. And almost to a company, everyone is now liquidity planning and thinking about how do I build a bridge to the other side of this health and economic crisis. And we've been a big capital provider into those companies as well.
Mike, as you mentioned, you started out with a $2 billion target. You exceeded it considerably by raising $3.5 billion. Why not more, though? And the reason I ask is, as you're well aware, firms that compete with you are raising multiples of that, north of $15 billion. Why? Ares is a big company. Why wouldn't it want to raise a bigger fund?
Well, we are. So we tend to be a little bit more diversified in the way that we raise capital. So on our first quarter earnings call, we told the market that we raised close to $7 billion of new capital. Publicly announced in the second quarter, we've raised an additional $6 billion of new capital. So this particular strategy was 3.5, but fundraising across the platform continues at a pretty healthy clip. And not surprisingly, most of the strategies where we're seeing accelerated fundraising are able to play the market dislocation in some way.
Any idea how much you think you'll be able to raise over the course of the calendar year?
Well, we had said pre-COVID coming into this year that we expected to hopefully exceed our record year, which was a year ago, about 36 billion. As I just mentioned, we're about 25 billion run rate, and as we talked about in our first quarter earnings call, our expectation is that we'll probably be somewhere within that range.
Mike, there is a significant gap between the performance of your BDC, Ares Capital Corporation, and the high yield market. And we can chart it. If you look, the high yield market has almost come back. It's just about at the level it started the year at. And Ares Capital Corporation, like many other BDCs, is still trading at a significant discount to the level at which it started the year. What explains that?
I think it's a perfect example of what I just articulated, which is the difference between the technicals in the liquid market and what's going on in the fundamental economy. So what I think is going on is folks are looking at the BDC market and effectively saying, I'm buying or expressing a view on middle market credit. I think what they're missing, particularly when they look at a company like Ares Capital Corporation, we as an investment grade rated company with billions of dollars of liquidity and a pretty solid investment grade liability structure are very well positioned to continue to perform through this kind of distress. There may be a view that across the BDC sector, generally speaking, that there's a higher exposure to lower quality credits. And so if you actually go through and parse the high yield index by rating, you'll see obviously a pretty significant difference of opinion between the lower rated quality credits and the higher ones, and that could be it.